Hey guys, for more like this, don't forget to hit the subscribe, the like button, and the notification bell. Okay, everybody, it's Kevin Wadsworth and Patrick Currim, and we're really pleased to welcome back Dale Pinkert, Forex Stop Hunter at the Tradegate Hub. How are you doing, Dale?
Doing okay. Great to be with you, Kevin and Patrick. I call you guys the astronomic technicians. Not that you use planets, but your views into the markets are very macro. People appreciate it. I watch your videos too, guys, and people really like the long-term nature of your stuff. And, you know, uh, why don't we start off with one of the things that Patrick talks about. He's very interested in what markets do on a quarterly basis, and then on a monthly basis is even more macro.
Wow.
So yeah, let's look at the
That the
monthlies.
4 hour chart that wasn't looking good on the 4 hour chart, the
No,
SPX.
no, we did have a reversal week. It almost looks like this, guys. Back in July, before the August peak, we had an inside month, started off higher and reversed and had a real negative next month. I'm expecting some type of March low, maybe into the uh, spring equinox. It's only about 3 weeks away. The Fed's there, a lot of things happening. But yeah, great observation. The S&P's really things that would be tailwinds, like when the dollar was weak and the euro is still up 70, and yields have not made new highs. In fact, yesterday when the S&P sold off, the 10-year yield came in. Now, oh, here we are. I was just
Wow.
talking about we'd
Wow.
be at 4%. So that's part of it, what's going on here. But look, we are not confirming here. This must have been the ISM. I knew we had some ISM news out here. But this
No,
is
hold on,
not.
Dale.
Go
What do
ahead.
you mean confirm on the indicator? You want to see the indicator
Yeah,
do a new high also?
yeah. I mean, I believe. Look, we've been diverging in the 10-year since here, 23rd of Feb. So for a couple of weeks, we haven't made a lot of progress, and now we are. We're starting to spike up. But look at where the RSI is. It's not above 70. So if this is just, one day wonder and we're not really spiking to, where I think we could go um, by the end of the year and make new highs up here, there is a chance that, we're just completing this first wave out of here, Kevin. I mean, this is where it started not that long ago on the NFP number, back at the, end of January. And so it's really only been about 5 weeks, and look how much we put on, 70 bips. So it's come and here people were wrong-footed, looking for, when's the Fed going to pivot or lower rates. And now you're kind of getting the same extreme. How high can the terminal rate go? Depends on which Fed governor is speaking. But I think there's a chance that we peak out here and maybe pull back to the breakout before we go to new highs in the 10-year yield. So just something to keep an eye on. This was something I saw happening. It's a breakout. We had shorter term breakouts on, right around the 358 level. And so that's something that could come into play. It was a little head and shoulders bottom right here. Okay. And we tested it. And then here's that larger breakout. We tested it. So the path of least resistance is definitely higher yields, but I'm tactical. And when everyone's starting to agree with me, they weren't down here when I was talking higher yields, but now I have a lot of company that yields are going to go to new highs. I think it sets it up for some type of break. And I'm wondering what could do it. Why would yields come off? And the only reason I could really think that maybe they would is if we have this breakdown in the S&Ps under this 3,900 is really the battleground. Here's the breakout in S&Ps. So we close under 3,900. That really opens the door for 38, 37.50. The battleground for this whole rally since the October low is we're there at 3,900. So we'll see. I actually lean more towards that we're going to have a March low in a lot of different asset classes, which tie in with a dollar high, maybe up here around 106. So, that's my narrative, is that most things you want to buy, you'll be able to buy cheaper. Gold, maybe not. Gold, the gold and the yen are really closely with yields, very closely correlated. And the yen peaked here yesterday when the gold bottomed at 1803, which was 1804, which was a fib count. What I'd like to see is silver, which now is putting in a good candle. But we never got to the fib here at 2020. That's 61.8 of that whole move from 1780, 2020. I'd like to see silver make a new low, take out this 2040 low 2020, and I'm guessing that gold will put in a higher low. That would be a setup I'd be looking for. And the miners, maybe one more drop in the miners if we break down under 3,900 in the S&Ps, it might take the miners with them, but they look good. I mean, I have a piece on from before the lows that we had, but now I'm in a position where I didn't want to have FOMO, and I went with, well, look at the month, just like the S&Ps had a reversal month. Look at the ugly month that all the metals had and the miners had. Look at this candle. So, I'm a believer like Pat, that I think we have to challenge or take out this monthly candle low before you could get a reversal candle, right?
Okay.
So in order for there to be, right now it's inside, right? We have an inside month happening. I think we have to challenge the lows there. Here's silver's monthly. Doesn't look as bad, but I think we could take out the monthly low and go to 2020 and then start reversing. Gold had a bad candle, but its structure has been so much better than silver because of this. And this is another reason why I think that there could be one more dip in silvers, because the gold silver ratio is pretty powerful up here on a 4-hour basis. Look at the Mo. See the Mo here? And look at the RSI. So markets rarely peak when you're getting 80 readings along with new highs. It's confirming this move. But now if we get a new high in the gold silver ratio, say towards 90, we will not take out 80. And you'll have your first divergence in the gold silver ratio, which I think this is something I talked about the last time we were together. Didn't help me with direction, but that wedge, it's been one heck of a move. So I think that's getting long in the tooth, but we're not done yet. Go ahead, Patrick.
Do you have a take on the gold versus SPX ratio? Like, how do you see that going?
I know you watch it. I don't watch it. I'd like to see it. Has it shifted dramatically in the last couple of days with gold's performance and S&P sideways to lower? Maybe you could take over the screen.
I think so. Well, yeah, like, yeah, I don't know if I want to. Kevin, you want to show it, or we could do it?
I thought show that, because I know that's important in your work, and you brought it up when you were with me a week ago.
Because when I saw gold's today's performance, and then I just noticed that SPX going sideways, gold that means it's creeping really close to a shorter term breakout versus SPX, which is it's practically required for silver. Gold could be breaking out versus SPX, and silver could still have that downwards momentum and vomit a little bit more. But then after that, it gets sucked up with gold, you know?
Yeah.
But
so I think it's all about yields, right? At least for the first part of the story. And if we have one more spike in yields, we'll see how silver handles it and gold handles it. And the dollar. I know some people, there's some different narratives floating around you haven't heard for a while. There are some people talking about, gold's going to take out 1610 and trade 1500. I'm definitely not in that camp.
There's the gold to SPX ratio there. I think, can you just confirm you're seeing the screen? Sure. You're seeing the screen, Pat?
No, we see only Dell's screen.
Okay, I stopped sharing. Now you can put it up.
Okay, just give me a second. I'll see if I can share the screen. Hang on.
That's what's great about these interviews with you guys is it's collaborative. I feel like it's more of a mastermind, the three of us getting together, than, someone's a host and someone's interviewing. We're just collaborating. And
it's good to share ideas and knock ideas around. And,
that's the good stuff. We don't script anything. The good stuff happens on things that we talk about that we didn't plan to talk about. Right. But anyway,
it might show and it might not, but we rarely script anything that we say. In fact, I don't think we ever do.
Beautiful chart, nice work. Yeah,
that's the gold to SPX ratio, and the main thing. This is the quarterly candle chart because it goes back to before the Second World War, and with that kind of data history, you can spot the signals to buy gold in 1930, and then the signal to swap out of gold and back into the stock markets in the early 1940s, and then the signal again on the breakout to go long gold versus the S&P around about 1968-69, and then and you can follow that all the way through. And the most recent signal, or most recent two signals, were in 2002, signaling, or should I say, confirming the new precious metals bull market that took us through to 2011 there. And then in 2011, what happened was on this ratio chart, if you look closely, you can see that there's a nice support line there. It was actually a resistance line that we broke through on the way up, and we created this this point at the top here, which was also another resistance level. We hit this resistance zone here. You can see this line here, and we hit that point and we were rejected. And then the important thing for a chart trader at that point is to look for a breakdown, should a breakdown happen. And a breakdown did happen, and we actually started making lower lows on this ratio, and we broke down below one of the key moving averages, which on this chart is in fact the 7-year moving average. And I just need to make sure that is the 7-year.
Look, there's that 1500 number that you have up on the description above the line about gold getting to 50%. So do you have 1500 in your head? Do you have 1500 in your head, Kevin?
The ratio here, 50%, if S&P was somewhere, or if gold was 50% of the S&P, that would give the breakout. So 1500 gold, S&P around 3,000, or 2,000 gold and S&P 4,000. Any number between those two numbers would give the breakout. But you can zoom right in on this, and you can have a look real close on the chart.
We're right there. We're there.
And you can see that we're right on the breakout line. As you get right in now, we're right on that breakout line. So it wouldn't take very much at all to give us a breakout. And of course, there's a little bit of leeway on how you position this line, whether you do it on a monthly candle chart. If you do it on the quarterly candle chart and you do it on the closes, there is actually a case to be made that we've already broken out. If I put this on the line chart and you look at the closes on the line chart, you can actually say that we've broken out and could be just coming back for a little back test on here. Put it on the monthly candle chart and you put it on the candles, and then you have to slightly reposition the line. And this is where you have to use a little bit of common sense with technical chart analysis, because nothing is absolutely 100%. There's no how can I put it, definitive position for that line. You have to view it as a little bit of a zone of resistance, and that the price has to work its way through that little zone of resistance. All of these line positionings are correct. There's no right position and there's no wrong position. All you can say is there's a zone of resistance in here. Because of that, because there's a bit of ambiguity, you have to look at the next confirmation level, which is this red line here. It's the 0.5 level, 0.5. And once we get above 0.5, that kind of takes away a lot of the doubt. You get a monthly close above 0.5, 0.5, and then really I think we can start to look with quite a lot more confidence towards a precious metals bull market. And this is what it's all about. Chart trading is all about getting confidence. I think sometimes people, and I think you probably agree with this, Dale, people get the idea that chart trading is black and white. It's like a light switch, go, no go. It's not quite as simple as that. You have to use and acknowledge the fact that there's a little bit of a gray area when you have these breakouts. It's not quite as straightforward as some people would like to make you believe.
Yeah, the art of it is the when.
Yeah.
Not the if. The art of it is the when.
Yeah.
The timing aspect of it. Okay, so
let's
okay, go ahead.
The other thing quickly just to mention, of course, is SPX versus inflation. And when you look at SPX, if you were talking, Dale, a moment ago about SPX perhaps moving down by 200-300 points, perhaps a little bit more. But of course, if it does do that, then this chart comes into play because it would start to signal a confirmed breakdown, only the fourth one in 100 years for S&P versus inflation. And you can see that if you zoom in at the moment, S&P is in the process of breaking down versus inflation. And if we get a little bit moved down now for the SPX, then this SPX versus PPI chart, which is inflation, then that would give a confirmed break below the red line there. Sorry, I don't want to take up any more of the time here. I'll let you talk.
You know, just a narrative. I'm looking for a lot of turns around the equinox. Okay, Spring can believed in it. The Fed meetings are there. So, you know, my bias is the dollar rally terminates there. Okay. The S&P decline terminates there. And that we have a risk-on market until the summer. And then I think things can really unravel after that. But I think there's a trading low coming across the board. I mean, really, it's all one market. It's only been, the only difference is magnitude of the moves, but everything's moving together, right? Based on what yields and the dollar's doing. So if the dollar weakens again after it's completed this bounce and the milkshake guys aren't right, and we're not going to 140 or 114 again, I think you'll see risk on when the dollar's bad, buy the world. And that also means, you know, Europe and emerging markets. And so everything's keen upon what happened, and metals and commodities in general. You know, I think that's really the scenario so people could get prepared for inflection points this month.
What do you think about
markets?
With just a question I wanted to ask you, and I ask this quite a lot from our guests, you know, with those yields going up to 4%, possibly in the future higher, 5%, and who knows how high. What do you think the implications are in terms of, you know, debt repayment for the United States and the ability to meet debt obligations with, you know, over 30 trillion of debt? There's a very good reason why rates and yields have been low over the last 40 years, because debt to GDP has risen from 50% to, I think, somewhere at the moment near 130%. So debt to GDP during the last 40 years has increased very significantly. And now we're seeing rates breaking out to levels that we haven't had with these levels of debt. So of course the debt repayment obligations are going to be much higher. So that's a problem, isn't it?
There's an expression that anything that could go wrong in a bull market doesn't, and anything that could go wrong in a bear market does. And there's extreme complacency, just like there is in the VIX. VIX is broken, VIX is dead. I'm looking for 30 VIX. That will go through all the theatrics in Washington. And just like every other time, they'll raise the debt ceiling. And there's a possibility with the acrimony in Congress and what's happening geopolitically and what's happening with having failed auctions already. 30-year auctions are not, there's no bid to cover on them anymore. That we could have a self-inflicted wound. And even if it doesn't go to default, it doesn't have to for U.S. debt to receive another downgrade, which wouldn't be helpful. So I think people are too complacent that we're going to raise the debt ceiling, and it may look a little different this time than the last 20 years.
Yes, and it's an interesting problem that the United States is going to face over the next few years. It's certainly something I've been keeping an eye on over the last several years, anticipating this sort of deteriorating backdrop to the economy, and it's going to be fascinating to see how it plays out.
Luke Roman says it's a binary choice, to default and save the dollar, or wreck the dollar and save the bond market. That there really aren't any other choices. It's binary. So they may try, what they're doing is they're trying one for a little while, then try another one. I think the dollar will be the sacrificial lamb.
Also, talking about the dollar and currencies, it's going to be interesting to see how cryptocurrencies perform over the coming sort of few months and into the next year as well. I know a lot of crypto bulls are really convinced that the bull market, the next bull market, has begun. Technical chart analysis is suggesting caution at the moment, but certainly I know a lot of crypto bulls are hailing cryptocurrency as the answer to all of these problems.
Well, technically it looks okay. That I didn't catch a bottom because it was just seemed too easy, and I'm too jaded. And it was just a little saucer bottom, just grinding, going nowhere. I could share the chart, but it did. I was looking for that one last capitulation. Thought we'd go to 14. 15 was a low. But the action is pretty good, and I don't own any, and I missed it, but I'm looking at if we get a pullback towards 20, and I think we might go to 27 first. Here's 1, 2, another push up. But it really does have an amazing feature that if you could just memorize 13 years, you could be anywhere in the world and have access to your wealth. The portability aspect of it, there's nothing that compares to it. And in World War II days, they were gemstones. And I don't know how much you bench, Patrick, but try and carry a couple of silver coin bags around and run with them in each arm. But you might need a massage after that, buddy. Anyway, so that portability aspect, and I really don't understand the whole thing except that, its use and everything. But I could see as CBDCs roll out that people are going to be freaked out about them, and that could drive people into an alternative, and Bitcoin's an alternative. So I think the low might be in.
Interesting stuff. Yeah. We'll know before too long, I'm sure.
Yeah.
What would be your target?
I'd be happy to be wrong and be able to.
What's your target though for Bitcoin? If let's say the lows are in, at what point do you bail?
Okay, I'll show you. Here's the monthly. That's your chart, right? Okay.
Yeah, that's where I live.
Okay, what do you have here? 1, 2, and to me this is incomplete, and I can't rule out a move above these highs for a third drive for a completion. I mean, it's a lot of work. People are going to be bearish all the way up, aren't they now? We're at resistance here. I think the way to trade it without being Nostradamus is whatever it's going to do here, wherever it peaks here, is you try and buy it at 20, and you're wrong under 15. And if it turns into be another, they could get one more mania going because people don't want to roll into CBDCs with their currency, I think that there could be a tremendous move to the upside. This to me now, when I look at it a monthly, was like a false breakdown. I wouldn't be short. Sometimes that's the ultimate compliment when you say, I may not feel like reaching and chasing to buy something, but I wouldn't short it either.
Exactly. That's what I call no man's land. When people we told people to go Bitcoin short, like above 50,000.
I know you guys are real right up there at 55.
Exactly. But now I call it no man's land. It's hit a support level. It doesn't mean you go long here, but it doesn't mean you go short here. You need to let it tell you, you need to let it base, just like it did a huge base from after crashing in 2017 to 2019. It needed 2 years to even think about breaking out again after it bottomed. 2 years it took, and that was when SPX was breaking out versus PPI. So I'm just saying, it's in no man's land right now, and it's time to look at other asset classes. Did you see sugar? Sugar's going bonkers there. We've been all over. I know you like my sugar charts, but sugar's going bonkers right now. It's like, and I had some fundamental guys tell me, sugar, it's supposed to crash. There's something about Brazil and whatever. And I say, I don't care. Sorry, that was my rant.
Yeah, opinions are like, what? Everyone has one. Anyway, so, here's my big play for 2023, and I think it's going to be a 2-year play, is to buy things like Fortuna Silver Mines, and consider that this was the first wave out, and we're going to put in a higher low. So far, it's held the 50% level. Maybe it goes to 61.8. Same thing with Endeavor, putting in a higher low. There's a lot of space for it to move. I mean, you talk about Bitcoin now, if it went to 100 grand, that's a 5-bagger. I see the potential for 5-baggers. In fact, here's a technical along with a fundamental call. So for Fortuna, and we talked about it last year, and I was a little early. I had to ride out about 70, 80 cents to the downside and ended up making money on all my gold positions. I was early. But, I learned a few things by at least being in these particular stocks. I saw how they behaved for about 4 months. I saw which one gave me the most performance when it was working. And out of all the stocks I was in, this was a double on that move in gold and silver. And what I see here is wave 2 that could set up a move, from 3 or 280 to 6, and then eventually 9. And you have a rectangle here. And if you covered up the title and I said, how do you trade it? You would tell me, well, if I liked it, I'd have a stop under the lows. I don't want to be long if we break down. And if you were bullish and it got up here, you'd be looking for potentially, you're going to be booking things all the way up. But a breakout at, say, round numbers, $10, and 3 hits down here, we've only had 2 up here, that would measure to about $16. So that's a 5-bagger.
Also, don't forget, Dale, all of this, that move that took place in 2020 into 2021 there, where it moved from $2 to $10, all of that happened without, and I'll say it again, without gold breaking out versus SPX. That was a
wow.
That was a move that took place without the capital flows to help you. Just imagine, having the capital flows to help you. If gold breaks out versus SPX, you can probably forget about $10, forget about $15, forget about, you're going to highs that aren't even on this chart at the moment, because those kind of capital flows, if gold and gold miners start to capture some of those capital flows from the stock market, just like they did in the 1930s, the 1970s, and when we saw that big move, that big move actually in 2000 to 2011, that happened. Am I right here, Patrick? I'm just trying to visualize the chart in my mind. That happened without gold breaking out versus SPX, didn't it?
So what you're talking about, Go ahead, Patrick. I'm sorry. Go ahead.
Gold breaks out. It broke out versus SPX
It
in
did.
2000.
Yes, right.
But the thing is,
Yeah.
gold, I just want to, in 2020 to 2021, when we saw FSM do that rally that Dale showed us, gold was doing a bear market rally within that bigger gold to SPX. Because remember, we just looked at it, it was basing and it did break out for a few candles versus the SPX. But that rally for gold versus SPX that it set up, that launched FSM from that bottom rail all the way to the top, was a bear market rally. So Kevin was talking about is the next time gold breaks out versus SPX through that huge wave, it's different this time. It's not a bear market rally anymore.
Because the capitalization of Microsoft, it would if you just took all the capital out of Microsoft and put it into miners, you wouldn't be able to execute all the trades. There's not enough float, market cap in miners compared to one of the mega stocks or FANG stocks.
Of course, as capital comes out of SPX, it's going to flow into multiple other sectors, including precious metals, country plays, commodities. Uranium looks very well placed, for example, other key metals, perhaps battery metals and that kind of thing. But what you need to identify is sectors that battle each other for capital. So because of the financialization of assets, certain sectors will move together. Tech moving with crypto so far is one example. Of course, that may decouple, and crypto could go to the moon whilst Nasdaq and tech goes nowhere for several years. But generally speaking, you can categorize many. I put it on my Twitter the other day. Bitcoin equals Ethereum equals Litecoin equals Nasdaq, equals Amazon. If you own one of those, you own all of them because they're all moving in sync with each other. Obviously, the amplitude of the moves vary, but the broad overall directional move for all of those things that I mentioned there and many, many others are together. And there's another set of assets that will move contrary to that. And spotting those assets that are moving contrary are what you want to do, because when SPX breaks down versus those assets, then that is where you're going to get this kind of huge move. And precious metals, it's going to be really exciting when it does eventually happen.
Yeah, I think
everyone's giving up at the moment.
Well, no, you know what? I don't understand why, because up here everyone thought they missed it when gold was 1950. Okay.
Yeah,
I don't know if you guys were following me. I was actually bearish up there, and especially because silver wasn't making new highs with gold. And then on the employment number in silver, if you ever want a classic lesson, and please, people, take this to heart when it comes to stop placement. Okay. So in silver, let's just go to the daily. Don't put your buy stop 2-3 cents above a swing high or a swing low, because this was a classic stop hunt. We took out the stops over these highs here, this high, which was 53, and went to 6 by a dime, 62. And now you're liquidated out of your short position into a reversal day and into a pretty good collapse. Give your stops room to breathe and give it tolerance. So this will not be the last stop hunt you're going to see. They happen all the time. Do not put your stops right above a swing high or swing low where everyone else has them, because the algos are like liquidity and it's like a magnet. Don't be part of the magnet. Place them outside of a magnet range. Maybe give your stop one daily ATR above a swing or high low. So that's going to, increase the risk on the trade. But I'd rather increase the risk on a trade than be right the market, wrong the trade.
Yes.
Use less leverage if you have to do that.
Yes.
So
we wait. That's why there's so much noise on the smart time frames. If you want to read, I wait for the monthly close always. And if I get a monthly candle close above a breakout line, then I know
you're ready to fine tune and finesse in. Right?
I could enter and I could put my initial sell stop below the previous swing low. But I 100% agree, because people get greedy, Dale, and they always they put their parameters, their entry, their sell stop, their exit, and then they look, it's only a 3-to-1 risk to reward. Let me put my sell stop a little bit tighter so I could add a 6-to-1 risk to reward. But they get greedy, and every single time you get greedy, you want a bigger position size, then the market's gonna, you get trapped in that volatility, and the market's gonna stop hunt and grab you. And
it took me 20 years to get over that. That's people's paradigms. You don't know how much better I trade with small size, and I sleep. And, you know, it's like I've been saying lately to people, you know, just like you have to be patient about waiting for your levels, that's not the end of your patience. Then you have to have patience about building your position where you don't go all in at the same moment, because you know, hitting something on the button can happen, but it's the exception, not the rule. So have patience putting on your position as much as you had waiting for your levels to do so.
There's the voice of a lot of experience there, Dale.
Right.
And I know both Patrick and I completely agree with that. Patience and not, you know, taking unnecessary large amounts of risk to try and catch falling knives and to try and be the hero. That's not the way to be successful if you're going to be in this over a period of time. Get lucky once, yeah, well, that's luck. If you're going to be doing it over a period of time, you'll soon soon have the battle scars. And I know Dale's passed on a lot of wisdom there. Please do.
That's why. Yes, that's why we appreciate you, Dale, because you have a framework. Me, look, somebody does that wave, whatever their technique, I listen to them, and then if I hear all these check marks, risk management, position size, sell stops, then I respect the guy's framework, and it's perfect. But people who go trading, they see the guy with the Lamborghini and the castle, and Patrick, how come you don't own an island? Well, if ever somebody converts 10K into 100K in less than a year, I'm telling you, he took unnecessary risks, because that's just not the performance you should be expecting. Like a 10-fold increase in your entire NAV over a year. That's like, what the hell happened there? You know,
it's the classic allure of a gambler versus, you know, somebody who is doing this in a professional manner. And you know, maybe the gambling attitude that seems kind of sexy and everybody's attracted to it, but that is one fast way to lose your capital, that's for sure.
The best traders I know are grinders. They grind it out.
Yes,
they grind it out, and they do cartwheels at 25% returns a year.
Yes, thank you.
That's an important point.
Yes, this is it. Even 30%. I put on Twitter 30, but I was getting greedy. Even the professional ones, the ones that had 30, 40 years track record, the average in between 20 and 30. Some years are negative. Some years are -5. Some years are plus 45. But yes, I 100% agree, Dale. And we have to fight the FOMO, that craziness we see out there. The newbie guys, they get their checks, and nobody knows about risk and money management. I'm on a crusade to teach people that, because it's not a lottery ticket trading. It's not a lottery ticket. It shouldn't be. Anyways, I'm sorry.
Yeah, it's okay. You're passionate about it. I back your mission with this statement: the difference between pros and amateurs are pros know how to lose, so they have money left to be right with.
I like it.
Let's close with that. Dale, tell everybody where they could find all your stuff, please.
All right. You know, at TradeGate Hub, we're not selling a subscription, so, you know, we don't compete with you. It's sponsored by a broker. We have a free room where people could come in. We have a YouTube channel. TradeView does not serve Americans. It's a foreign broker. I mean, but you could trade everything there, CFDs, everything. And I also host Face, where I've interviewed you on both places. I have to get Kevin in there. And that webinar is free as well. And Forex Analytics is in the business of selling subscriptions and prop trading. So no pressure from me in any place. You know, I just want people to do well. And that's why I bring guys like you in, so that people can find their cup of tea and learn. And I don't worry about a subscriber finding a place he's happier at than being with me. Because sometimes I don't want to be with me.
You're very generous with your time, Dale. We're going to put all those links in the YouTube description, and Yeah, it was an honor to talk to you again.
I'm a fan of you guys. Keep your telescopes clear. March is going to be a great month. I'm looking forward to it.
Good stuff, awesome. Dale. We appreciate your time.
Buddy.
Thank you very much for joining us.
All right, my trading warrior brothers. See you later.
Cheers, Dale. Bye for now.